Welcome to Iron Financial, the place where we stress test company reports to help you forge a stronger portfolio. Today, we are putting Suncor Energy directly under the microscope. You know, their latest earnings report, it looks like a masterpiece of industrial might. We're talking record production, record refining, and yeah, the market gave it a little nod of approval. But our job here, you know what it is, it's to look past those polished headlines and really kick the tires. So here's the question we're asking. Is Suncor a newly forged cash machine that's built to last for the long haul, or is it a ticking time bomb just waiting to trap investors who are lured in at the peak? Let's dig in.
So Suncor's Q4 report, it really landed like war drums, a declaration of absolute, undeniable strength. They are firing on all cylinders, hitting what their own CEO is calling best ever performance. Let's put some hard numbers on that, okay? In their upstream business, that's the heavy lifting of pulling oil out of the ground, they hit a record 909,000 barrels per day. Then in their downstream business, refining that crude into the gasoline and diesel we all use, their refineries pushed through another record, 504,000 barrels. Look, these are not just good numbers. These are new, massive benchmarks for the entire company. Suncor is trying to paint a very clear picture here. They're an industrial titan that has completely and utterly mastered its craft.
And this, right here, this is the absolute core of management's new narrative. The CEO, Rich Kruger, he put it so bluntly on their earnings call. He just said, "We were previously a high-cost producer, now we are a low-cost producer." Now listen closely, he is not just talking about one good quarter. He is declaring a fundamental, a structural change in the company's very DNA. What he's telling the market is that the old Suncor, the one that was kind of dangerously vulnerable to every single swing in commodity prices, is gone. It's history. And in its place, he says, stands a lean, efficient machine that is built for one thing, to generate cash, even when oil prices are working against them. Now that is a bold claim we're going to put to the test.
Hold on a second. Bold claims are cheap. I see the record numbers, I get it, but we have seen plenty of glory quarters from companies right before the entire foundation cracks. So is this a real fundamental transformation, or is it just a fresh coat of paint on a very old engine? That's the exact question we're here to answer. And to do that, we're running our full Iron Financial stress test. First, we'll look at that record-breaking year. Then we're going to pop the hood and look at operations. After that, we'll forge the financials and take a hard look at their shareholder policy. Then you're going to get your chance to point out all the cracks in the armor before we deliver our final verdict. Let's see if this thing actually holds up under pressure.
All right, first things first, let's look at that polished armor, the big headline numbers from their record-breaking year. Suncor didn't just meet expectations here. They blew right past them, signaling to the street that management has a firm, confident grip on the wheel.
And the precision of this beat was really significant. Look, Wall Street was forecasting earnings around, 73 cents a share. Suncor came in and delivered nearly 81 cents. That is a 10% beat on the bottom line. Now, let's be clear. That is not a rounding error. That is a statement. It tells you that their internal cost controls and their operational output were far, far better than even the most optimistic models were predicting. Revenue also came in higher, which just confirms the trend. They sold more product, and they did it way more profitably than anyone on the outside thought was possible. These are the kinds of hard numbers that make serious investors sit up and pay very close attention.
Okay, so the stock popped a bit over 1%. That's nice, but let's be real. A 1.3% bump isn't exactly a paradigm shift, is it? It's a polite nod of approval, not a standing ovation. So sure, the market liked the numbers, but it wasn't euphoric. My question is, why were the numbers so good in the first place? A headline beat tells me nothing about what's actually happening inside the machine. What is driving this performance? Is it sustainable, or was it just a one-off alignment of the stars? We've got to go deeper than the surface.
Exactly. It is time to go under the hood. Financial beats are completely meaningless if they aren't built on a foundation of solid steel and real-world output. We need to see if Suncor's engine room has truly been rebuilt from the ground up, or if it's all just smoke and mirrors.
And this, right here, is where the story gets really, really compelling. Just look at the engine's output. Upstream production hit a record 909,000 barrels a day. To put that in perspective, that shattered their previous best by a massive 34,000 barrels. At the exact same time, the refineries were pushing a record 504,000 barrels a day through the system. This isn't one part of the business carrying all the weight for everyone else. No, this is an integrated machine, operating at peak performance from the oil sands mine all the way to the gas station pump.
And here is the most crucial point. This growth wasn't bought. They didn't do some splashy, expensive acquisition to get these numbers. It was, as the CEO says, growth from within. They took the exact same assets, the same machinery they had 2 years ago, and they literally squeezed an extra 114,000 barrels a day out of them. That, my friends, is pure efficiency. It's the result of better maintenance, better planning, better execution. This is the heavy lifting that separates a world-class industrial operator from just a mediocre one. This is earned growth, not bought growth. There's a huge difference.
Okay, I'll concede the operational turnaround is impressive. I mean, achieving a 3-year strategic plan in just 2 years, that is a testament to disciplined execution. They promised production growth, they promised lower break-even costs, they promised reduced debt, and they delivered. Ahead of schedule. That builds credibility for sure. But that brings me to the most critical question of all. If the engine is running this hot, if they are pumping out and refining more product than ever before in their entire history, then why did their actual profits fall year over year? Something here just doesn't add up.
You've just hit the key stress point of this entire analysis. That's the question. Operations look like a fortress, no doubt. But do the financials actually match that strength? Soaring production with falling profits. That could signal a fatal flaw in the entire business model. So, it's time. Let's forge the financials and see if this fortress can truly withstand an assault.
Exhibit A. This is the slide that gives me serious pause. In the fourth quarter of 2024, Suncor posted adjusted operating earnings of nearly $1.6 billion. Okay, a year later, in the fourth quarter of 2025, their supposed best-ever operational quarter, those same earnings fell to $1.3 billion. That is a drop of almost 15%. So let me get this straight. They're doing more work, they're breaking records left and right, and they're making less money? Explain this contradiction to me, because right now it looks like they're just running faster to stay in the exact same place.
This is the whole thing, isn't it? This is the core of it. We've seen the humming engine room, we've seen the impressive output, but if the end result is lower profit, what's the point of it all? Is this the first major crack appearing in the armor? Is this where the entire transformation story just starts to fall apart? Because if they can't turn operational records into financial records, the whole bull case is on some seriously shaky ground.
Okay, let's break this down, because the answer is right here in their own analysis. This chart, the bridge or waterfall chart, this is where we separate what management can control from what they can't. Look right here, the second bar from the left, price, margin, and other revenue. That is a massive negative $533 million hit. That right there is the external headwind. That is the commodity market punching them square in the face. Lower oil prices cost them over $500 million in earnings. But now look at the very next bar, sales volumes and mix. That's a positive $412 million. That is the internal strength. That is their record production fighting back with everything it's got. So yes, earnings fell. But the key takeaway here isn't weakness. It's that their operational excellence offset almost 80% of a massive commodity price drop. This doesn't show weakness, it proves resilience. It shows the new low-cost structure is working exactly as it was designed to.
And while the market was all focused on that one earnings headline, management was busy doing something far more important for the long-term health of this company. They were building a financial fortress. They used the cash generated from that incredibly efficient engine to aggressively, relentlessly pay down debt. Net debt now stands at $6.3 billion. That is its lowest level in over a decade, since 2014. By deleveraging the company, they've made it fundamentally stronger, less risky, and it gives them incredible flexibility to either weather future storms or seize new opportunities. This is what real financial discipline looks like in practice.
The CFO, Troy Little, he summed up their entire philosophy perfectly with this quote. He said their future isn't defined by the cycles themselves, but by how well they perform through them. They've rebuilt this company to be an all-weather machine, a structure that's strong enough to sail through the troughs of the cycle, not just ride the easy waves of high prices.
All right, now for the ultimate proof of discipline. How do they treat the owners of the business, the shareholders? Suncor claims that for them, shareholder returns are not some afterthought. They are the absolute bedrock of their entire strategy. Let's see if that's true. Let's just talk about the sheer scale here for a moment. In 2025 alone, Suncor returned $5.8 billion to its shareholders. That is a massive, massive commitment. And look how they did it, with a really balanced approach. $3 billion went to share repurchases, which, as you know, reduces the total number of shares out there and boosts earnings per share for everyone who remains. And another $2.8 billion was paid out in cold, hard cash through dividends. This isn't some token gesture, this is a core function of their entire business model. Okay, the numbers are big, I get it. Repurchasing over 160 million shares through their buyback program, what's known as a normal course issuer bid, or NCIB, that's significant. But here's my challenge. Is this just a fair weather policy? You know, it's easy to be generous when energy prices are high and cash is flowing. What happens when the cycle turns ugly? Are they going to stick to this shareholder-first mantra when cash flows get tight? Or is it just good marketing while the sun is shining? That's what determines if it's a true philosophy or just a talking point.
And that right there is the knockout punch. The CFO addressed your exact point on the call. His words were, "We don't pay you what is left over. We pay you first." He then explained their capital allocation process. They look at cash flow from operations, and the first thing they do is immediately allocate capital for the dividend. Then they fund the share buyback program, and only then, after shareholders have been paid, do they consider other capital spending. This completely reframes the entire process. Shareholders aren't an afterthought getting the scraps left over. They are the #1 priority. This philosophy, if they stick to it, is the bedrock of their entire value proposition to investors. All right. The internal machine is strong. I'm convinced of the operational turnaround, I'm convinced of the financial discipline, but no fortress exists in a vacuum. It is time to identify the cracks in the armor, the external storms that could still come along and wreck this ship, no matter how well it's built.
Look, the crucial point here is this. No matter how well-oiled this machine is, it's never going to be invincible, especially not in an industry this volatile. Our job here at Iron Financial is not to be cheerleaders for a company. It's to find the risks and put them right on the table for everyone to see. The bull case is clear. Now, let's build the bear case.
And these aren't hypotheticals. These are clear and present dangers that are outlined in their own risk factors. First, and most obvious, fluctuating oil prices. Yes, they've built a more resilient company, but at the end of the day, they still sell a commodity. A deep, prolonged price crash will hurt them, period. Second, regulatory changes. The energy sector is constantly in the political crosshairs. A new carbon tax or new environmental rules could add billions in costs overnight. Third, geopolitics. A conflict in a major oil-producing region could disrupt everything. And let's not forget about market saturation in refining and the ever-present long-term pressure of the energy transition. These are powerful forces that management absolutely cannot control.
The risks are real, and you've laid them out perfectly. We've run the stress test, we've looked at the operations, we've hammered on the financials, and we've examined the capital returns. Now it's time for the Iron Financial verdict. Is Suncor a fortress, or is it all just a facade? All right, let's put the two cases right next to each other. The bear case, as you've argued so well, is that despite all these improvements, earnings are still ultimately vulnerable. A price collapse or a harsh new regulation could erase all their hard-won gains. The bears would say this record performance we're seeing right now, it's a peak, not some new sustainable plateau.
Exactly.
And the bull case is that this is a fundamentally different company, that the combination of operational excellence, a rock-solid balance sheet, and that shareholder-first capital plan has created a machine that is literally designed to endure those very cycles. And based on all the evidence we've just gone through, the facts point firmly towards the bull case. That transformation from a high-cost to a low-cost producer is the single most important factor. Their integrated model, from mining all the way to refining, provides a natural hedge that non-integrated producers just don't have. The structure they have forged is designed specifically to withstand the exact pressures you've identified.
So let's go back to our central question. Is Suncor a high-performance cash machine built for the long haul, or is it an investor trap? The Iron Financial verdict is in. While those external risks are absolutely real and should never, ever be ignored, our stress test shows Suncor has successfully rebuilt its foundation from the ground up. They have proven they can execute, they can control costs, and they can generate massive cash flow even in a weak commodity market. They've demonstrated a rare and incredibly valuable discipline in both fortifying their balance sheet and rewarding their shareholders. In our view, this is not a trap. This is a compelling opportunity to own a best-in-class operator that has been forged for resilience. And remember, it's this kind of rigorous, no-nonsense analysis that helps you cut through all the market noise and forge a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.